Hello learner, welcome to Manifested e-learning forum. My name is Emlyn Nguiri and I'll be taking you through alternative investment analysis. In today's topic, we are still dealing with hedge funds, and to be more specific, we are going to look at the following. So we are looking at hedge funds. So we are going to look at factor models. So factor models for hedge funds. So how do investment managers within the hedge fund universe or airspace determine the returns? We are going to look at factor models, and then we will move on and look at the motivations for hedge fund replication strategies. Replication strategies. As in, we are saying, why would it be good for an investment manager or an investor within the hedge fund airspace be willing to replicate the hedge fund returns as it has already been created or been prepared? We will move on and look at the difficulty or the difficulties in applying portfolio analysis to hedge funds. Then why is it difficult in applying traditional portfolio analysis in creating or in trying to predict the component of alpha, the excess return? We will move on and look now specifically under the difficulties. We will be looking at the difficulties. So we'll be looking at difficulties to develop expected returns, as in it is difficult to develop expected returns. We'll move ahead and also say that hedge fund performance can be dynamic, tends to be dynamic, can be dynamic, like that. That is another reason. The third and final reason is that standard deviations is an incomplete measure of risk. Is an incomplete measure of risk. Then we will conclude this lesson by looking at funds of funds. That. Now that is the breakdown of what we are going to look at or to learn in today's lesson. Now we start off by looking at factor models. So factor models for hedge fund returns. So that is what we are going to look at first. We can mention the following. Having had a very solid background about hedge funds, we can say this, that in order to understand the risk or the risks they are taking and receiving, we're talking about the investors, that is, each hedge fund investors seek to use regression analysis to quantify and separate the alpha. Return, that is what we're talking about, the value added, and the beta return. Beta return, that is what we're talking about, the market return. Like that, associated with the fund's return. Associated with the fund's return. That. So we are going to look at a model, a simplistic model or the general model that is used within the hedge fund universe. So we're saying the HF return, we can say HF return is given as the summation of the alpha plus the risk-free rate, and then we add now the cumulative component of the beta times the factor sensitivity. So summation of beta, I think it's better for me to put it somewhere else down here, plus, so there's a big plus there, so we open the brackets over here, summation beta I multiplied by the component of factor sensitivity. So factor I there. So we're saying this is the component of beta times the factor. So this we're saying is the factor sensitivity, and this is the factor itself. For example, we can be able to have the CAPM formula like that, RF plus RM minus RF beta. That. So this beta over here represents the component of factor sensitivity. This is the factor itself, or the equity risk premium, like that. So in regression analysis, we are saying it will be, this equation is of the form y is equals to b0 plus b1 x1 plus b2 x2 plus b3 x3 plus an error component right there. What is not explained by these independent variables like that, x2 and x3, these are independent. They are not affected by any other factor. What is not explained by these independent variables will be explained by the error term there. So that error term is maybe a factor that has not been included within this model that contributes towards the significant values in independent variables there. So we are saying that these x1, x2, and x3 are the ones that influence the y right there. So we are saying if we have the Farmer French model like that, where we have three factors like that, the return component in the Farmer French model, for example, is the one that is determined by, say, for example, equity risk premium. We're also talking about the high book to market, the book to market component, and then we're talking about the small cap stocks, the difference between the small cap stocks and the large cap stocks right there. So those are the factors that influence the return of a fund like that. So you can see it is almost, so you're seeing this is the B0 component plus the risk-free rate over here. The risk-free rate is probably maybe considered to be a factor over here, x1. Then summation of now the factors. The factor sensitivity times the factor itself. So this represents the factor itself. This is the factor sensitivity. This is B1 is the beta. This is beta 2. This beta 2 represents the factor sensitivity that influences x2. This is the beta sensitivity that influences the factor x3 like that. So that is a typical regression model that is used within the hedge fund airspace. Having looked at this hedge fund return, now we need to now appreciate now the motivations for hedge fund replication strategies, and that is what our next point is. Right here, we are saying the motivations for hedge fund replication strategies is a very key component. So this, since hedge funds, like I mentioned in our previous lessons, that it has not been introduced here in Kenya, although it is almost similar to mutual funds, we can be able to try and adopt similar models that are used in the mutual funds, which is also considered to be a traditional investment there. We are saying that hedge funds, or even the regulations relating to hedge funds, have not been created here in Kenya. It's up to us as analysts to try as much as possible, yes, to try and have an investment platform or an investment platter where you can be able to select investment options from whatever fits your investment strategy. Like that. So now we move on to look at the motivations for hedge fund replication. So we look at motivations for hedge fund replication strategies. Hedge fund.
Thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners. Visit our shop along Tom Boyer Street, Pioneer House, 3rd floor, opposite Fire Station.